Welcome to the deep dive. We're the show that, takes these incredibly dense financial reports, 10Ks, 10Qs, all the analyst stuff.
All those pages you don't want to read.
Exactly. And we pull out the core insights, the stuff you actually need to know, without the jargon overload.
And today we're digging into a big one, Alphabet, ticker GOGL. It's a really critical time to look at them, I think.
Yeah, definitely feels like an inflection point. So our mission today is pretty clear. We've got the latest numbers, Q3 2025 earnings, H1 balance sheet data.
Very current stuff.
Right, and we need to unravel this kind of strategic puzzle they've got going on. We want to answer three key things for you, the listener.
Okay.
1, how's Alphabet actually doing right now? 2, what's the big strategic bet they're making, that massive spending?
The AI bet.
Exactly. And 3, what's the final call? What's our recommendation on the stock based on all this data?
And the hook, like you said, is that puzzle, that contradiction. It's almost hard to wrap your head around the scale.
Yeah.
Well, on one hand, they just blew past a huge milestone. First ever $100 billion quarter. Q3 2025 revenue was, $102.3 billion?
Just massive scale. Seems unshakable.
But then at the exact same time, management is pushing the boat out. Like way out. They're signaling this huge investment.
We're talking about the CapEx, the capital expenditures.
Yeah, analysts are projecting somewhere between, get this, $91 billion and $93 billion for the full year 2025. That's just unprecedented internal spending.
It's basically daring everyone else to even try and keep pace.
It really is. It kind of defies financial gravity for a company of this size. So we got to figure out, okay, why spend that much? What does it do to profits in the short term? Is it going to crush their margins?
Or is it absolutely essential, like the insurance policy they need for the future?
That's the core question. So this deep dive is all about cutting through the noise, looking at the reports, and finding the financial reality behind that huge number.
Okay, let's start at the beginning. Segment 1. The business model. The engine that actually generates all the cash needed for these huge bets.
Right. So Alphabet Inc. Big holding company, parent of Google, obviously, sits in that internet content and information space.
But it's the structure that's really interesting, isn't it? How it's set up.
Absolutely. It's quite smart, really. It protects the core moneymaker while letting them, experiment and invest heavily in other areas, even if they lose money initially.
And it's not just one thing propping it up. You call it the revenue tripod.
Yeah, 3 main legs holding it all up. Pillar number 1, advertising. Google services, that's the old faithful, the original cash cow.
Still printing money. The Q3 numbers showed, $74.2 billion just from ads in that quarter?
Yep. And the reason it's so strong, so durable, is twofold. First, search. They've got 90% plus market share. It's almost unbreakable. Decades of data, user habits.
Hard to compete with?
Very. And second, YouTube. #1 video platform globally. That gives them this incredible hold on video advertising, which keeps growing.
So for advertisers, it's not really optional, is it?
Not if you want mass reach. It's pretty much essential. That guarantees a steady, huge flow of cash.
Okay, pillar 2. This feels like the really strategic one right now. Google Cloud, GCP, and Workspace.
This is the growth engine. And definitely where a lot of that future investment focus is going. It's the main battleground.
How's it doing against the competition like AWS and Azure?
Growth is impressive, up 34% in Q3 25. And it's not just basic storage they're selling. It's enterprise services, AI infrastructure, tools like Vertex AI, Gemini for cloud users.
So winning here means owning the future's plumbing, essentially.
Pretty much. Owning the infrastructure.
Yep.
And that's key to defending the main advertising business long term, too.
Makes sense. Okay, pillar 3, the stability leg. Subscriptions, platforms, and devices.
Yeah, things like YouTube TV, YouTube Music, Google One memberships.
This gets overlooked sometimes, maybe.
I think so, but it's really important. It gives them diversification away from just ads, which can be a bit cyclical.
And it's recurring revenue, predictable cash.
Exactly. The analysis points this out. Stable, growing, reliable cash. They've got over 300 million paid users now across some services.
So that provides a nice baseline, gives them the confidence to make those huge CapEx bets elsewhere.
Precisely. They know the basic bills are covered, so to speak, thanks to these sticky subscriptions.
Okay, so that's the tripod structure. Now, let's look at the growth story over time. Just how impressive has this scale become?
Oh, it's genuinely exceptional. We look back over the decade, from 2014 to 2024, revenue went from $66 billion.
Wow, seems small now.
Right. To $350 billion in 2024. The compound annual growth rate, the CAGR, works out to about 18.1% per year.
That's huge over a decade.
It is. And the sources emphasize this massively outpaced average inflation. So they weren't just riding the economy, they were actively taking share, expanding their economic footprint significantly.
What's really striking, though, is that the growth hasn't really slowed down much, even at this massive size. You'd normally expect single digits by now.
We're not seeing that fatigue yet. Fiscal year 2024, they grew 14%, Q2 of 25, another 14%, and then Q3, it actually ticked up slightly to 16%.
Sustaining 15% plus growth at this scale.
That's basically the textbook definition of a powerful economic moat, right?
Yeah.
It shows the competitive advantages, tech, network effects, sheer capital prison. They're actually getting stronger, not weaker, as they get bigger.
Okay, let's connect this scale and growth to the bottom line. Profitability. This is where that term operating leverage comes in, right?
Absolutely. And the efficiency gains here are really quite stunning. Look at the operating profit margin, OPM.
What is the number?
It was already good at 27.4% in 2023. It jumped to a really strong 32.1% in 2024.
Well, that's a big leap.
It is. And even in Q3 25, when they had that big one-off legal fine hit them,
Right, the $3.5 billion European fine payment.
even with that, the OPM was still 30.5%. So more than 30 cents of every single dollar in revenue is turning into operating profit. That's elite level for a company this complex.
And a big driver of that margin improvement was Google Cloud finally turning profitable. Let's talk about that cloud flip.
Yeah, this is probably the single most important development on their income statement over the last couple of years. For ages, cloud was a drag on profits. Necessary investment, sure, but losing money.
And now?
Now it's consistently profitable. In 2024, it made $6.1 billion in operating profit. And get this, just in the first half of 2025, it made $5.0 billion.
So more than double the profit from the first half of the previous year.
Exactly. That's huge acceleration.
So they've essentially plugged a major hole in the boat, profit-wise, proves that all those billions poured into cloud over the years are finally paying off.
It's proof of concept. And it
Yeah.
feeds directly into that idea of operational leverage, which just means profits are growing faster than sales.
Because costs aren't rising as fast as revenue.
Right. If your costs grow slower than your revenue, you get leverage. And the data really bears this out for Alphabet.
How so?
Well, look at FY 2024. Sales grew 14%, which is great. But net income rocketed up 36%.
Wow.
Same pattern in Q3 25. Sales up 16%, net income up 33%. It shows massive efficiency gains. As search scales, as YouTube scales, as cloud scales profitably now, those underlying fixed costs get spread thinner and thinner.
Leading to way more profit dropping to the bottom line for each extra dollar of sales.
That's the hallmark of a top-tier tech business model.
Okay, let's circle back quickly to the advertising moat. The analysis mentions immense pricing power, even with competitors like Meta, Amazon, TikTok breathing down their neck. How does that work? How can they have pricing power with so much competition?
It's down to the mechanism they use to sell ads. The core ad business runs on this highly competitive, automated auction system. That's the key.
So Google isn't just setting prices.
Not directly. They facilitate the auction. Advertisers are constantly bidding against each other for the best spots on search results or YouTube videos. Why? Because the demand to reach Google's massive user base far outstrips the supply of those premium ad slots.
Ah, so Google doesn't have to raise prices. The competition among advertisers does it for them.
You got it. It's like a self-pricing engine. And that structure gives them that immense pricing power, which you see reflected in those high, stable operating margins. It proves demand for their ad space is incredibly strong relative to their costs. It makes that ad business a very protected financial engine.
Okay, so we've got this picture of enormous revenue, growing profits, increasing efficiency. Now let's look at the foundation supporting all this, the balance sheet.
Yeah, and Alphabet's balance sheet isn't just strong, it's, well, the analysis calls it a fortress. It allows them to make these massive bets that almost no one else could even consider.
Let's look at the numbers from the H1 2025 report, so June 30th. What's the cash situation?
It's almost unbelievable. $95.1 billion, just sitting there in cash, cash equivalents, marketable securities, ready to deploy instantly.
Wow, okay. And what about their ability to cover near-term debts, so the current ratio?
Extremely strong, 1.9. The analysis calls it extremely strong and safe. Basically means for every dollar they owe the next year, they have almost $2 in easily accessible assets ready to pay it off.
So immediate solvency isn't even a question.
Not at all. Zero risk there.
Now, you'd think with that kind of massive CapEx spending we talked about, they must be taking on a ton of debt, right? Leveraging up.
That's what you might assume, but nope. This is where their financial strength is just on another level. Their debt-to-equity ratio, DE, it's incredibly low at 0.08.
0.08. That's tiny.
It means they're funded almost entirely by their own profits, their retained earnings, their net worth. Not by borrowing. It's a pristine balance sheet. They just don't need external debt to operate or grow.
Let's use another metric to hammer home how safe this debt level is. Interest coverage.
Yeah, this one's almost funny. Their operating profit covers their annual interest payments 419 times over.
419 times.
Yep, think about that. It's like paying your entire year's mortgage with less than 1 day's pay.
So they earn enough profit in what, less than a day to cover all their interest costs for the entire year?
Exactly. It highlights this incredible strategic advantage. Total financial independence. They don't need banks. They don't need bond markets.
Okay, now for what you called the gold standard test. Cash flow. Super important for listeners to get. This accounting profit isn't the same as actual cash you can spend. So we compare net profit after tax, PAT, with cash flow from operations, CFO.
Right. And this comparison for Alphabet, it's probably the single best sign you could possibly see in a financial report.
What did the numbers show for, say, 2022 to 2024?
Over that 3-year period, cumulative cash flow from operations was $318.6 billion.
Okay. And cumulative net profit?
$233.9 billion.
So CFO was 136% of PAC. Cash flow significantly higher than profit. Why is that? And why is it such a good sign?
It confirms the earnings quality is top-notch. The profits are real, they're backed by cash, and then some. The reason cash flow is higher is mainly due to big non-cash expenses that reduce the reported profit number, but don't actually involve cash going out the door right now.
Like depreciation.
Depreciation's a big one. That's the accounting charge for servers and buildings wearing out. And stock-based compensation, SBC, is another major factor. It lowers accounting profit, but gets added back to cash flow.
So the bottom line is Alphabet is just generating enormous amounts of actual spendable cash.
Drowning in it, essentially. Which brings us right back to the core strategic issue. Capital allocation. What are they doing with all this cash? And that $90 billion question mark.
We really need to stress how huge that projected 2025 CapEx figure is. $91 to $93 billion.
Management is clearly in an aggressive spending war. They spent $52.5 billion in CapEx in 2024. Then, just in the first 6 months of 2025, they laid out $39.6 billion. So that projection for the full year, it's a massive acceleration.
It's almost double last year's number, and it's significantly more than their entire free cash flow over the last 12 months, which was around $73.5 billion.
Think about that. They're planning to spend more on physical infrastructure in 1 year than all the cash they generated after maintaining their business.
So why the sudden urgency? What exactly is this $90 billion buying?
It's explicitly aimed at winning the AI infrastructure race, number one, and supporting that accelerating Google Cloud growth, number two. They are physically building the future,
Right, yeah.
Massive new data centers all over the world.
And crucially, buying specialized hardware, right?
Exactly. That's a key piece.
Right.
Especially their custom tensor processing units, the TPUs.
Explain TPUs and why they're worth this kind of bet.
Okay, so unlike general-purpose chips like GPUs that many competitors use, TPUs are custom-designed silicon. They're built specifically for the kind of intense math needed by these huge AI models, like their Gemini 2.0.
So a potential advantage.
Potentially a critical one in cost, in speed for training and running these models. By controlling the hardware, TPUs, the software Gemini, and the delivery, Google Cloud, they're aiming for this vertically integrated system that's just faster and more efficient than anything else out there. That $90 billion is largely about filling their data centers with these custom machines.
It's a clear signal they see AI not just as an opportunity, but as an existential fight they have to win.
Absolutely. But the spending isn't just internal CapEx. There's also that massive planned acquisition, $32 billion, all cash, for Wiz, the cloud security company.
Yeah, why spend $32 billion on security right now?
It totally confirms their strategic focus is shifting heavily towards the enterprise market, towards cloud. Wiz is a leader in cloud security posture management. Meaning, if Google Cloud wants to really steal those big, lucrative enterprise clients, banks, healthcare, governments from AWS and Azure, they need top-tier, unquestionable security. Enterprise customers are incredibly careful about risk.
So buying Wiz is like buying instant credibility and security for the cloud offering.
Exactly. It's a $32 billion shortcut to say our cloud is secure, period. It's about cementing that cloud growth and locking in those high-margin contracts.
Okay, so massive internal spending, massive external acquisition. Yet somehow they also started returning more cash to shareholders. Let's cover shareholder returns and value creation.
Yeah, it's remarkable they can do both simultaneously. The big shift was starting a quarterly cash dividend in 2024. That really signaled to the market, okay, we're a mature cash gushing business now.
And they already increased it.
Yep, up 5% in April 2025. And alongside that, they're still buying back huge amounts of stock. $62 billion in 2024, another $28.6 billion just in the first half of 2025.
So, investing heavily in the future and giving back billions to shareholders, that leads to the overall value creation metric, which sounds pretty impressive.
It really is. It's kind of the ultimate test of how well management uses the money it keeps.
Yeah.
Between 2014 and 2024, for every single dollar of profit, Alphabet kept and reinvested in the business.
Yeah.
It created $3.53 in new market value for shareholders. The analysis calls that world-class performance. It proves they're incredibly good at reinvesting capital productively, constantly making that economic moat deeper.
All right, we've painted a picture of Alphabet as this, well, financial and tech titan, but nothing this big comes without risks. And the risks here are pretty substantial, right? Concentrated in two main areas.
Definitely. The first major risk bucket is the competitive landscape and innovation. Specifically, that threat from generative AI messing with their core search business.
They face tough competition everywhere, don't they?
Absolutely formidable. Microsoft with Bing and OpenAI, Meta in ads, Amazon in cloud, even Apple with the OS, TikTok chipping away at attention. It's intense.
But the AI threat feels different, more fundamental. If people start getting answers directly from chatbots instead of clicking on Google's 10 blue links,
Then the whole ad revenue model, which triggers on those clicks, is potentially disrupted. It's an existential threat to the core moneymaker.
which explains the $90 billion CapEx spend.
Exactly. It's not a luxury, it's a necessity. Management is betting the farm, essentially, on winning that AI infrastructure race to protect search. They're throwing everything at it, that $49.3 billion in R&D in 2024, deploying Gemini 2.0, projects like AlphaFold 3.
And deploying it across all those products with billions of users, Android, Chrome, Gmail, Maps, Play Store, Search, YouTube.
Right. Using their massive scale as a weapon to try and out-innovate and out-deploy everyone else simultaneously.
That scale is incredible. But it doesn't solve the second huge risk, which the analysis calls the regulatory threat. And it labels this the single greatest risk they face.
Yeah, this one is huge, and it's really hard to put a number on. It's global, it's complex. It could genuinely force them to change how they operate, hit those amazing profit margins, or even,
Force a breakup.
in the worst-case scenario, yes, forced divestiture of parts of the business. The uncertainty is so high, Alphabet themselves say in their filings for many of these cases, they cannot estimate the possible loss.
Okay, let's get specific. What are the key legal fights? The biggest one is the U.S. Department of Justice case about search dominance, right?
Correct. The DOJ argues Google kept its monopoly using illegal tactics. And Google took a big hit in August 2024 when the court ruled against them on liability.
So now it's about the penalty phase, the remedies. What happens next?
This is the critical part, expected in the second half of 2025. This is where the real structural risk lies. The DOJ has proposed a remedy framework.
What kind of remedies are we talking about? What could they force Google to do?
It's a range. It could be behavioral changes like forcing them to share certain data or stop favoring their own services and search results. Or it could be structural,
Which means?
which means potentially forcing them to sell off key parts of their advertising technology business, separating the auction part from the inventory part. Any of these could drastically change the competitive game and really hurt those profit margins we discussed.
And that's just search. There are also lawsuits targeting the ad tech engine directly.
Yep. Multiple suits from the DOJ in various states are focused squarely on their dominance in ad technology. Trials are set for early 2025. If remedies come out of those, it could force major changes in how the whole ad system works, potentially reducing their pricing power.
Plus, we can't ignore the Google Play Store case.
Right, the Epic Games lawsuit. The jury found against Google back in December 2023 on antitrust grounds. Google's appealing, but remedies ordering business changes were issued in October 2024.
And if those stick?
Any forced change to how they run the Play Store, especially around payments or revenue sharing, hits that stable third pillar of revenue, the subscriptions and platforms. It would reduce profitability there.
And then there's Europe. Always a factor.
Always. The European Commission remains very active. They're facing huge fines. Remember that $3.20 billion cash payment in Q3 24 for the old shopping case fine being upheld.
And new rules, too.
Exactly. They're under intense scrutiny with the new Digital Markets Act, the DMA, which is specifically designed to curb the power of gatekeepers like Alphabet. So this regulatory risk isn't just one lawsuit, it's global, it's coming from multiple angles all at once, and it's very unpredictable.
Okay, let's pull this together with the margin of safety assessment. Usually when you invest, you look for a cushion, right? A margin of safety in the price you pay. Is Alphabet cheap? Does that cushion exist?
Based purely on the valuation metrics. The short answer is no. The analysis is clear. No margin of safety exists in the purchase price.
What's the PE ratio telling us?
It's high, around 27.8 times earnings. That's right at the top end of its industry average. The market is fully pricing in all that growth and profitability. You're not getting a bargain here.
So, if it's priced for perfection and you have this massive looming regulatory risk, shouldn't a careful investor just stay away, or at least wait for a pullback? Isn't buying at a premium price too risky given the potential downsides?
That's absolutely the right question to ask, and it forces us to shift focus. If there's no safety in the price, is there safety somewhere else? And the argument here is yes, the safety lies in the business model itself.
In that financial fortress we talked about.
Exactly. We can actually try to quantify this internal strength using something called the self-sustainable growth rate, or SSGR.
Okay, break down SSGR for us. What does it measure?
It calculates the maximum rate a company can grow using only the cash it generates internally. No new debt, no selling new shares. It's a pure measure of internal financial power and durability.
And what is Alphabet's SSGR?
It's calculated at around 31.8%.
Okay. And how does that compare to their actual growth rate?
Well, their actual growth recently has been in that 14% to 16% range. So the SSGR of nearly 32% is significantly higher.
What does that gap tell us?
It tells us the company generates a massive surplus of internal cash. Think of it like a car that can go 32 miles per hour, using only the fuel it makes itself, but it's choosing to cruise along at 15 miles a hour. It has huge reserves. It could theoretically double its current growth rate without needing any outside money.
So the sheer financial power, that huge free cash flow, $73.5 billion over the last year, acts as its own kind of buffer. It protects the business from most operational hiccups or economic downturns.
That's the argument. The overwhelming quality and durability of the cash flow is the margin of safety here. It's not a price discount, it's business quality resilience.
So the investment case hinges entirely on believing in that exceptional business quality, enough to justify paying a premium price for it.
Precisely. You're paying up for quality and durability, not getting a bargain. Hashtag track conclusion and recommendation.
Okay, we've been through the numbers, the strategy, the risks. Let's try and synthesize this. There's a real tension here, isn't there?
Absolutely. On one side, you've got just undeniable financial strength, incredible profitability, that 32% plus OPM, market dominance in 3 core areas, amazing cash conversion, 136% CFO over PT.
Plus that massive forward-looking investment in AI, the $91–93 billion CapEx plan, and they're still returning tons of cash to shareholders.
Right, that's the certainty side. But then on the other side, you have the uncertainty.
The premium price tag, no discount there, and that huge dark cloud of global regulation, the DOJ cases, the DMA in Europe.
Which the analysis calls the single biggest threat, potentially capable of fundamentally changing the business.
So how do we balance that, the financial fortress versus the looming regulatory sword? What's the final verdict?
Looking at all the evidence, the financials, the analysis, the conclusion is that the strengths, particularly the company's sheer ability to fund its own future and defend its position, currently outweigh those risks. Provided, and this is key, management keeps executing effectively on this massive AI pivot.
So the internal power is just too strong to bet against right now.
That's the assessment. The capacity to self-fund growth and protect that moat is just immense.
So what are the key bullet points, the action points underpinning the final recommendation?
Okay, I'd say 5 critical things. 1, the tech moat, anchored in AI and search, is being actively and aggressively defended with that huge hardware spend. 2, profitability is genuinely world-class, those margins, that cash conversion. 3, the huge CapEx isn't random. It's proof of a focused long-term strategy to win the next big platform shift. 4, the balance sheet is a fortress, providing incredible internal resilience shown by that high SSGR. 5, the shareholder returns confirm maturity and a focus on capital efficiency.
So even acknowledging that massive regulatory risk is real and potentially damaging, the underlying quality wins out.
In this assessment, yes. The financial quality dictates the call. Therefore, the final recommendation for Alphabet, ticker GOEGL, is a BUY.
But it's a specific kind of buy recommendation, isn't it?
It is. It's explicitly a conviction bet on the quality of the business, its durability, and its ability to fund its future dominance, even though you're paying a premium price today. It's not a value play. It's a quality play.
Mm.
And maybe to wrap up, here's that final provocative thought, circling back to the $91 billion CapEx. Management is spending furiously to build the physical backbone, the data centers, the custom TPUs, the silicon for the next decade of AI.
Right, building their advantage.
But here's a tension for the future. Will this massive private investment, designed to create perhaps an even more unassailable dominance for Alphabet, eventually trigger even stronger regulatory action? Will governments feel compelled to step in and say, okay, this AI infrastructure is becoming too critical, it needs to be shared somehow?
So, will the very act of building the future necessitate regulation to open it up?
That's the multi-billion-dollar question, isn't it? That's the battleground technological dominance versus regulatory intervention that will likely define profits for years to come.
A fascinating point to end on. We'll definitely be watching that remedies phase and the regulatory developments closely. Thanks for joining us on the Deep Dive.